back to another edition of the Notes versus Alternate Investments series. In this video, we'll be taking a note and putting it up against the stock market and compare the differences between the two and see which one may be a better fit for your portfolio or how both of these strategies could assist with your investment goals. The first thing we need to mention is that this comparison is going to be very generic because these two investment vehicles are very different and both have more advanced strategies you can employ. However, they can both be used to grow a portfolio, but they'll grow it in contrasting ways, as you'll soon discover. The purpose of this video is to highlight how they could affect your portfolio and the risks that are associated with them. We'll start with notes, and the first thing you'll want to notice is that you're receiving fixed monthly payments with a yield attached to them. With stocks, you have to wait until you sell them or buy depending on your strategy. They're also backed by a tangible asset that you can take back in a worst-case scenario, as stated on prior videos. So notes could be considered a more secure investment in that regard because they have a built-in fail-safe when compared to the stock market. Now we'll pivot and discuss how the stock market compares to notes. And remember, we are looking through the lens of how they could affect your portfolio overall. Stocks, in the traditional sense, grow as the company increases over a period of time. As the company flourishes and becomes more valuable, the stock increases in value as well. But they could also decline in value, giving them an uncertain future. One thing the stock market is famous for is having big swings that increase the value of a company's stock. And when that happens, the investor that bought the stock early will see an upsurge in value. However, when was the last time your money manager or broker advised you to sell? We're fairly certain that call doesn't go out when the market drops. But this is where the two investments really start to diverge, because the stock market doesn't have anything tangible if the value of a company starts to decline, and the investor who owns that stock is subject to the trends of the marketplace if the market starts to slump. So the investor's capital is at risk and loss of capital can occur, which is a real and present danger along with the uncertainty that exists for those who choose this investment vehicle. So if passive, steady cash flow is your main goal, notes are a great way to have the security of monthly cash flow without the uncertainty of the market. Conversely, if long-term growth is your main focus, stocks could be a right fit for you if you have the tolerance for investing with the uncertain distant future with varying returns depending on the year. In short, notes require very little oversight, but stocks have to be constantly monitored. To be fair, both of these investment vehicles have more advanced strategies that could be implemented as we stated before, but we're keeping this comparison at a basic, generic level. We encourage you to run the numbers for yourselves and see which investment could be a better fit for your portfolio. The question you're going to have to solve is which of these two investment vehicles will move you closer to your investment goals for both the short and the long term. And which of these two approaches will serve your needs better. Thank you for joining us, and we'll see you next time.